Hello, everyone. Thank you very much for joining us once again today and welcome back. We are discussing today foreign source income. So we're discussing, as I mentioned, we are discussing foreign source income. In the foreign source income, we'll be discussing through the requirement of the law. Moreover, we'll be discussing the guide that has already been published by the Federal Tax Authority. So these are the previous webinar that we've already gone through. Foreign source income. Coming back to the same slide once again. We have already discussed this slide so many times, but again, I'm going to discuss. As we discussed earlier, person, it can be exempt, out of scope, taxable person. Taxable person can be generating income, resident taxable person as a resident taxable person or as a non-resident taxable person. We have already discussed that the resident taxable income, resident taxable person, their worldwide income will be subject to tax. Their worldwide income will be subject to tax. Here, juridical person who is a resident person, the place of effective management establishment is in the UAE. Even the person is registered out of the UAE. Still, this will be considered a resident taxable person for the UAE tax law, and their worldwide income will be subject to tax. Here, the worldwide income will be subject to tax. Natural person who is conducting business in the UAE, if that person is conducting business in the UAE, then any income related to that business, even this is being earned within the UAE, even this is being earned out of the UAE, both will be subject to tax. So business income subject to tax, even earned out of the UAE, it will be subject to tax here. In the same way, non-resident taxable person, law says the any income attributable to the PE of the non-resident person, it will be subject to tax in the UAE. This is income, foreign source income nexus in the UAE. Now I have added one more layer here today. What I added? I have added this layer here. When we are talking about the worldwide income means UAE. There is a possibility this worldwide income is being earned from the UAE and income is being earned out of the UAE. In the same way, this is applicable for the juridical person who is being controlled and managed in the UAE, even the person is established or incorporated out of the UAE. In the same way, it can be applicable for the natural person as well and PE of the non-resident person. This split of income will not be available for the UAE sourced income. If someone is starting out of the UAE and they are generating income from the UAE, but they don't have any PE in the UAE, so there is no possibility that income is being generated out of the UAE. If this person is generating any income out of the UAE, it will not be subject to tax in the UAE. In the same way, next is in the UAE, I believe the maximum possibility because next is related to the real estate property. So there is only one for the income is being generated from the UAE. So we are not considering this for the foreign source income. We are not considering this for the foreign source income. We are not considering this for the foreign source income as well. So these are the four possibilities. One is here. This is the second. This is the third. And this is the fourth. In these four situations, there is a possibility that the person is generating income from the UAE and the person is generating out income out of the UAE. If the person is generating income from the UAE, it will be considered UAE sourced income. We already discussed the definition of UAE sourced income. We will go through this once again as well. And if the person is generating income out of the UAE, this is called foreign source income. So this is applicable, as I mentioned, when the juridical person incorporated in the UAE, juridical person is out of the UAE but controlled and managed from the UAE, natural person is there generating worldwide income. PE of the non-resident person is generating income from the UAE and any income attributable to the UAE, but this is being generated out of the UAE. So this will be our core topic today. Foreign source income, foreign source income, foreign source income, and foreign source income. First of all, what is a foreign source income? In the UAE law, there is no definition of the foreign source income. I'm repeating, in the UAE law, there is no definition of the foreign source income. But law gives the definition of UAE sourced income. Any income that is UAE sourced, any income other than UAE sourced income, we can call this is a foreign source income. Foreign source income is the reciprocal of the UE sourced income. This is a counterpart of the UE sourced income. What is UE sourced income? The income that is being generated from the resident person. That is UE sourced income. Income that is related to the PE of the non-resident person. That is the UE sourced income. Any activities, if these activities are being performed in the UAE, this is called the UAE sourced income. So if the income is being generated from the non-resident person, income is being generated from the activity that is being performed out of the UAE, and if the income is being generated from any person who is not a PE of the resident person, who is not a PE of the non-resident person, who is not a resident person, that income is considered foreign source income. And when I'm asking the activity, if the activities are being performed in the UAE, it will be considered UAE source income. If these activities are being performed out of the UAE, it will be considered foreign source income. What type of activity, like sale of the goods, provision of services, contract, movable, remote property, these are the all activities. If these activities are being performed out of the UAE, I will say this is a foreign source income. Now, what are the various examples of the foreign source income? These are the examples of the foreign source income, like you are getting dividend, you are getting the income from the disposal of shares, deposits, loan, interest, activities performed out of the UAE. These are the various examples of the foreign source income. As I mentioned earlier, foreign source income is a reciprocal of UAE sourced income. One thing is important, if one person is a mainland company is generating income from the, if the mainland company is generating income from the free zone person, free zones are under the territory of the UAE, so it will be considered UAE sourced income. In the same way, if the qualifying free zone person, we have already discussed in the webinar of free zone person, the qualifying free zone person, if they are generating the income from the domestic PE, of the generating income from the foreign PE, both of the income will be straightforward subject to tax at 9%. Law says if the qualifying free zone person is generating income from the domestic PE, it will be considered their UE sourced income. And if the qualifying free zone person is generating income from the foreign PE, it will be considered foreign source income. Now, these are the various possibilities. These various possibilities, where these possibilities arise, that where the foreign source income can be arise. There is a possibility. These resident taxable persons, these means we have already discussed the resident persons, or it can be a resident person. It can be, sorry, it should have been taxable person, not resident. Taxable person. Taxable person that are generating foreign source income. These are taxable person. Taxable person can be juridical taxable person. It can be a natural person. It can be PE of the non-resident person. These juridical persons, as we discussed in our previous slide, it can be resident juridical person, it can be resident natural person, it can be PE of the non-resident person. Now, the resident juridical person, the company which is established in the UAE, this is a resident juridical person. Three possibilities are there. As I mentioned, three possibilities are there. The company is incorporated in the UAE, company is being controlled and managed from the UAE. Then if the company is incorporated in the UAE, there is a possibility this company has a subsidiary out of the UAE. There is a possibility this company has a PE out of the UAE. There is a possibility there is a no subsidiary, no PE, but there is a simple, they are generating the income that is being subject to tax, withholding tax provisions are there. So this company, the juridical person who was registered in the UAE, or the juridical persons who are the resident juridical person, so they can have subsidiary, or there is a possibility they have a full-fledged company out of the UAE as well that is being controlled and managed from the here. Now, this company, juridical person, the juridical persons, they have a company which is controlled and managed from the UAE, are incorporated in the UAE. There is a possibility they have one more company out of the UAE. They don't have the company that they have a branch fixed establishment which is become PE out of the, are they no subsidiary, no company, no PE. Still they are generating income out of the UAE. Might be they are giving a loan to any party out of the UAE, and the loan in tax is being withheld. There is a third possibility. The same thing applicable for the natural person. The natural person, they will not have, there is a very less chances that natural person will have a subsidiary or any other company out of the UAE, but most of the time natural person will be generating income out of the UAE through PE, or without any company, without PE. As I mentioned, I have just given the definition example of the loan as well. So third possibility is PE of the non-resident person. I believe there is a one possibility. There will not be any other company. There will not be any PE. The only way it might be any income they are attributable. Because if there is a branch, just look into this. If this company, UK company has a branch in the UAE that has become their PE of the non-resident person. Now this UK company has another branch in KSA. Then this branch of a KSA will be falling directly under UK. This branch of UAE will not be controlling this branch. But most of the cases, the chances are there the PE of the non-resident person, they will not have any company out of the UAE which will be being controlled and managed through the PE. They will not have any other PE, because other PE will be directly going to the main company. The most of the time, the chances are that PE of the non-resident person is generating income out of the UAE, foreign source income attributable to the PE, without any company out of the UAE, without any PE out of the UAE. Now, if this juridical person is they have any company out of the UAE, but this company is being controlled and managed from the UAE, or this company is already main company in the UAE and subsidiary out of the UAE, then means this is a company out of the UAE. They will be liable to register there. They need to submit the return. If the PE still PE will be liable to register there, need to submit the return. I'm assuming this that most of the cases, PE other company are liable to register. If the PE is out of the UAE, this company will be liable to register. Once they will be liable to register, they will be liable to submit the return as well. If there is no subsidiary, no company, no PE, then most of the time they are generating income, then tax will be withheld. Here, most of the cases withholding tax provisions will not be applicable. Here, most of the cases withholding tax provision will not be applicable unless and until they have withholding tax on the repatriation of the dividend. Here, most of the cases withholding tax provisions will be applicable of the respective country. Here, most of the cases withholding tax provision will be applicable. Here, most of the cases withholding tax provisions will be applicable. Here, they will be liable to register, submit the return. Based upon this, they will be liable to pay the tax. So, in based upon this slide, tax will be applicable here, most of the cases through withholding tax. Here, most of the cases through withholding tax. Here, most of the cases through withholding tax in the foreign source. Means this juridical person, natural person, PE of the non-resident person, they are generating income out of the UAE without setting up any company there, without any connection with the company there, without any PE there, and their tax is being withheld out of the UAE. And most of the cases, there will not be any related expenses as well. In these cases, the rest of the cases, which are this case, this case, this case, in these three cases, they will be liable to register there, they will be liable to submit the return in the foreign jurisdiction, they will be liable to pay tax. So tax is being paid. In three cases, this tax will be paid in the form of withholding tax, and in three cases, they are submitting the return, and relevant tax authorities are applying the any tax similar to corporate tax. Now, once this tax is being applied out of the UAE, this income is subject to tax in the UAE as well. So UAE authorities will be asking them to pay the tax in the UAE. They will be asking them, they have already paid the tax out of the UAE on that income. So this is the reason the concept of foreign tax credit has been arised. That will be discussing in detail. So foreign source income in the hand of the person, as I mentioned, is the resident juridical person, it will be subject to tax. If this is uh, resident persons or the natural person worldwide income subject to tax, juridical person worldwide income subject to tax, natural person income related to the business within subject to tax. So if the income is exempt, there is a possibility that this resident persons, natural person, juridical resident person, natural person, a PE of the non-resident person, might be they are generating income and this income is not subject to tax. They might be they are generating foreign source income and this foreign source income is not subject to tax. There is a possibility. It can be happen like in the case of like dividend and other income under the participation exemption. If there is a natural person generating business income less than 1 million, it will not be subject to tax. If the juridical person is claiming foreign participation exemption claim, this is foreign PE exemption claim, foreign PE exemption claim. under the Article 24 of the law, or their relief, there is a possibility the income will not be subject to tax. Means the resident juridical persons or natural persons or P of the non-resident person, they are generating income out of the UAE. That income is not subject to tax, but that is exempt income. There is a possibility. These are the various examples of exempt income. If there is income is exempt while calculating the taxable income on the UAE, they will not be considering this exemption in their calculation. They will not be considering the related expenses as well. Apple to apple comparison. Income is not subject to tax. Expenses will not be subject to tax as well. So this is a general rule. General rule says if you are generating income in the UAE or generating income out of the UAE, your worldwide income is subject to tax and the tax rate is same. Even this income is from the UAE income, even this income is out of the UAE. Again, I have included this slide just to give you again one more understanding, basically just to give you the recap that law doesn't differentiate the income that you are generating from the UAE. It will be subject to different tax rate. Income you are generating out of the UAE, it will be subject to different tax rate. One tax rate is applicable for the income either you are generating out of in the UAE, either you are generating out of the UAE. UAE sourced income, foreign source income, tax rate is same. Once the tax rate is same, but UAE sourced income will be subject to tax one time, and foreign sourced income you have already paid tax out of the UAE, so you will be again getting credit. This will come in there. Expenditure and losses related to the foreign source income. Now we are typically discussing the foreign source income. The law says basically any foreign source income, any related expenditure, it will be included in your UAE sourced income, or it will be included while calculating the taxable income in the UAE based upon the general rules of income and expenses. I am repeating. Foreign source income, foreign source expenditure will be considered based upon the generic rules and principles to calculate the taxable income. What are the generic rules? Generic rules are you need to consolidate the financials. After consolidating the financial, you need to look into this. What is your bottom line? Based upon this, you need to do the reverse working. After doing the reverse working, you will be arriving at your taxable profits. So whenever you will be taking the consolidated number based upon the financial statement, means foreign source income will already be part of your financials. Even you are a subsidiary, your company, or you are a natural person, worldwide income, PE of the non-resident, whatever is the situation, the foreign source of income will already be part of your financial. Once these are already part of your financial, you will be doing the reverse working. After doing the reverse working, you will be arriving at your taxable profits. Once you are arriving at your taxable profit, then you will be calculating the UE tax applicable to them. Once you are calculating UE tax applicable to them, then you will be looking into this, okay, how much foreign tax credit. While including the income, exempt income will not be considered for tax purposes. Means if your financial statement are including any income which is exempt from the UE corporate tax law, you will eliminate this while calculating your taxable income. If there are any expenses that you consider for accounting purposes based upon the generic principles of the expenses, some expenses you will not be allowed. These expenses will not be deductible to arrive at the taxable profit. And these expenses are like as within 50% of the entertainment expenses, non-business expenses, bribes. So many other expenses are there as well. So these expenses, these income will be following the generic principle or to arrive at their taxable income. This is what I'm trying to highlight. So once this generic principle apply, income, if income is exempt, related expenses will not be allowed. If the income is taxable, related expenses will be allowed. Related expenses will be allowed based upon the generic principle. And what are the conditions? They said these expenses are not allowed. Those expenses will be eliminated to arrive at the taxable profits. Once you are arriving at the taxable profits, then you will be claiming the foreign tax credit. And we will look into the example as well. So while considering, basically, as I mentioned, resident juridical persons, a resident natural person, PE of the non-resident person have a two sources of income. One is the UAE sourced income, foreign source income. Once is the foreign source income, foreign source, you already paid the tax out of the UAE. Once you already paid the tax in the UAE, then you need to consider the provisions of the double tax treaty to claim the foreign tax credit. Basically, wherever there are conflict, wherever the provisions of the double tax treaty are inconsistent with the provisions of the law, the provisions of the double tax treaty will override the provisions of the law. I'm repeating, where there are conflicting provisions in the between the double tax treaty and in between the UE tax law provision, the provisions of the double tax treaty will override the provisions of the law. So basically, whatever the generic principle of the law, we need to go through this. Whenever we have a cross-border transaction, whenever we have foreign source income, whenever we are looking to claim the foreign tax credit, we need to look into the provisions of the double tax treaty as well. Might be treaty will allow you 100% claim whatever the tax that you already paid out of the UAE. Might be treaty will restrict you as per the provisions of the law. We need to look into the treaty. What treaty says? What treaty says between the two countries? How can we claim the foreign tax credit? Just look into this example. This is very, I have just for your understanding, just look into this is UAE, this is Egypt. This company, these numbers are all in millions. This 100 million UAE, 60 million is the COGS, 40 million is the GP, selling, admin expenses, operating profit 12 million, other income is 1 million, other expenses 1.5, net profit is coming 11.5 million. Now this is Egypt. In the Egypt, this company is generating income of 20 million, COGS is 10 million, GP is 10 million, selling expenses 4 million, then operating expenses 3 million, operating profit 3 million, other income 0.5, other expenses 0.75, their net profit is 2.75. Now, based upon the generic principle, okay, I'm not going to tax for the time being, I'm consolidating the number. Just I'm keeping it very simplified. Whenever we are consolidating the number, consolidated profit is 14.25 million. And based upon this consolidated financial, you need to do the reverse working to arrive at the taxable profit. And for the time being, I'm assuming this income and these expenses, the treatment as per IFRS and treatment as per the tax law, both are giving me the same number. There is no difference. I'm assuming this for the time being. Means I'm assuming 100% expenses are allowable. I'm assuming 100% income is taxable. So if I'm assuming everything is consistent, the provisions are consistent just for the time being as per the tax law and as per the IFRS, my net profit will be equal to my taxable income. Once this is equal to my taxable income, then I need to calculate the tax on it. How can I calculate the tax? I said 14.25 million less 375,000 into 9%. It is coming 1.25 million, which is the tax. So it is coming 14.25 less 0.375 multiply 0.09, 1.248%, 1.25 million. This is my tax. Now, this company will ask FTA, okay, for UAE sourced income, you can calculate, you can take the tax, they're very fine. But for the Egypt, they will say they have already paid tax out of the UAE, that is 2.75. Again, this income is being included in this income as well. So do they need to pay tax again? Then here the provisions of the law and double tax treaty will come. This is very important, I am highlighting. Law says, it has been written in the guide as well, even the double tax treaty doesn't exist between the countries, still you can enjoy the foreign tax credit. I'm repeating, even the double tax treaty doesn't exist between the countries, still you can enjoy the foreign tax credit. Now you can enjoy the foreign tax credit. If there no double tax treaty, you will be enjoying maximum 9% of your taxable income, foreign taxable income. Again, if the double tax treaty exists, might be there is a possibility they will allow you this 100% as allowable expenses in the UAE. We need to go through the treaty if the treaty exists. Anyway, so this is my taxable income as per the UAE law. Now they said they have already paid tax out of the UAE, but the UAE law says you can claim maximum 9% of your tax due within the UAE, or whatever the tax you have paid out of the UAE, maximum 9%, or whatever your actual payment out of the UAE, lower of this you can claim as a foreign tax credit. You cannot claim any foreign tax credit beyond this. So how much amount of tax they have paid out of the UAE? Assuming my tax rate in Egypt is 20%. So 0.55 multiplied 20%, sorry, 2.75 multiplied 20%, 0.55 million. This is the tax that they have paid already out of the UAE. Now the UAE law says 9% of your taxable income pertaining to the foreign jurisdiction, you can claim maximum up to that. We need to, this is important. We need to calculate the taxable income, foreign source taxable income. We need to calculate the foreign source taxable income. And here in my calculation, I assume the provisions are same. If the provisions are inconsistent, might be in Egypt the provisions are inconsistent, might be the accounting provisions are inconsistent, you need to calculate the foreign source taxable income based upon the provisions of the UE tax law. Based upon the provisions of the UE tax law, you need to calculate the foreign source taxable income. So means this net profit you need to rework to arrive at the taxable income from Egypt. So once you are arriving at the taxable income of the Egypt, then you will be considering 9% of that. So 9% of that specifically law says you cannot apply here. Law says whatever your foreign, this tax that you already paid, the due in the UAE, which is 9% of this income, you need to consider weighted average method to arrive at the tax due on the foreign source income in the UAE. So my tax is 1.25. Based upon 1.25, if I'm applying the weighted average method, they're asking you need to base the income. How much is the income of the Egypt? 20. How much is the total income? 120. 20 divided by 120, you will be arriving the maximum tax due on this foreign source income, which is coming 0.25. So if I'm asking 1.25, 1.25 multiplied 20 divided by 120, this is 0.21. So this is the tax due on the foreign source income. How we have calculated? We have calculated the UE tax, then we applied the weighted average technique. After this, we are arriving. This is the tax due on the foreign source income in the UAE. This is a tax due on the foreign source income in the UAE. This is a tax paid out of the UE. Lower of this, you can claim this is 0.25. Remaining amount you will be liable to pay to the Federal Tax Authority. Here, I have gone to the double tax treaty of Egypt, and based upon the double tax treaty, still this restriction is applicable, which is maximum 9% of your taxable income. You cannot claim anything more than 9% of your taxable income. So 100% tax, whatever you have paid in Egypt, this is not allowed in the UAE. So this is called foreign tax credit. This is called calculation of taxable income. Foreign tax credit, we will be looking through some more provisions of the foreign tax credit. This is a similar example. If this is a PE in Egypt, this is a no PE in Egypt. If this is a PE in Egypt, treatment will be same as I discussed earlier. So total income will be included, the UE income, foreign source income. How can you claim the credit in the foreign source income? It will be lower the tax due in the UAE, 4.47, then 100 divided by 300, which is coming 1.49, 2.98. This is the tax in Egypt, this is the tax in the UAE. But if you don't have any PE in Egypt, or you don't have any company in the Egypt, that means you might be you are given a loan. From the loan, you are generating income. That loan is subject to withholding tax. Sorry. So most of the cases, expenses are not there. Only income 100%, 100 million, 20%, 20. Then income will be included here. This is your total income 139%. Again, the rule is same that we already discussed. 11.67 is the tax. Then lower of tax due in the UAE or tax paid in Egypt, 3.8 remaining will be taxable in the UAE. These are some very important provisions related to the foreign tax credit. We always need to consider these provisions while claiming the foreign tax credit. That the foreign tax credit is the lesser of the amount actually paid out of the UAE on the foreign source income and the tax due on the foreign source income. You can claim the foreign tax credit on the withholding tax as well. Some taxes like excise tax, property tax, custom tax, estate tax, inheritance tax, stamp duty, these are not considered the foreign tax purposes because these are not the taxes on the taxable income. Taxes on the taxable income, it can be given any name, any mode. If the tax is being levied on the taxable income, if the tax is being levied on the taxable income, that it will be considered equivalent to corporate tax. Any fines, any penalties for the non-compliance that you have paid out of the UAE, it will not be considered for the foreign tax credit. You will be required to give a proof of payment to the FTA to claim the foreign tax premium, and this proof of payment is the payment remitted to the FTA, or the second is payment remitted to the FTA. This can be one possibility. A second possibility is commitment to pay to the foreign tax, sorry, payment remitted to the foreign tax jurisdiction, or commitment to make the payment to the foreign tax jurisdiction, it is will be considered as paid. Now, once you have, there is a slight change in the UAE. I just wanted to highlight. Initially, you were able to take the foreign tax, basic tax residency certificate. Now, you cannot claim the tax residency certificate for the future period. Now, what is the process? I'm just going back to this example. If you don't have any PE in Egypt, your tax will be withheld by your customer. What the customer will do? They will withhold this tax. How much is the amount? 20. They will deposit this amount to the Egyptian tax authority. Now, based upon the tax treaty, you have a right to claim this 20. Based upon the tax treaty, you have a right to claim this 20. Here you cannot claim because it has become PE there, you will be liable to register there. Once you are registered there, you will be liable to pay tax. Maximum 9% of the taxable income you can calculate in Egypt. You can recover a claim in Egypt, in the UAE. But if there is no PE in Egypt, then and you are proving that the UAE, you are the tax resident person in the UAE, then you need to go back to the Egyptian tax authority. You need to request them that you are a tax resident person of the UAE. You don't have any PE in the Egypt. Then after verification, Egyptian tax authority will give this amount back to you. But based upon this amount might be to take this refund from the Egyptian tax authority. It will take 1 year, 1.5 year, whatever. And before this, you already claimed this credit here and you paid the net amount to the UAE tax authority. I'm repeating. I'm repeating. There is a possibility that your tax has been withheld by the Egyptian customer. They have remitted this tax to the Egyptian tax authority. And you have a right to take this 100% tax back by proving to the Egyptian tax authority that you are a resident taxable person of the UAE and you don't have any PE in the Egypt. Then Egyptian tax authority will give this tax 100% back to you. There is a possibility before this claim you have already claimed the foreign tax credit in the UAE. Now you have claimed, you have not paid, you have paid the tax in Egypt, you have taken it back, and you have claimed the foreign tax credit in the UAE as well. There are two things. Now, once this is the case, now this is the provision. Then, if there is any amendment in your tax, wherever this tax has already been withheld and paid, or even you have a branch over there, even you have a whatever basically whatever tax you have paid, you have taken it back in the respective foreign jurisdiction. If you have taken this tax back or there changes in the tax amount, maybe you will be liable to pay more tax in the respective tax authority. The law says if the tax, whatever you have paid in the foreign jurisdiction, this tax has been refunded to you or this tax has been decreased and this decrease is greater than 10,000. It means you have taken a benefit of more than 10,000 in the foreign jurisdiction, then you need to pass the VD. And if this benefit is less than 10,000, then the law says you can adjust in the return. But if these changes and based upon these changes, you will be liable to pay more tax in the respective foreign jurisdiction, then again you need to pass the VD. Moreover, the foreign tax credit cannot exceed the amount of UAE corporate tax due. We have already discussed this. It can be lower of the tax due or tax paid, and tax due will be calculated as it is tax due as per the UAE tax law, foreign source income divided by total income weighted average method. We have already applied this even in our previous example. Where taxable person has multiple sources of income. Okay, now the company, they are generating income from Egypt, they are generating income from the KSA, they are generating income from Bahrain. They cannot offset. Okay, Bahrain will be treated separately, KSA will be treated separately, Egypt will be treated separately. We cannot offset taxable income of the one jurisdiction, it can be against the other jurisdiction. Foreign tax credit is not available. This is important. Foreign tax credit is not available if you are not paying tax in the UAE. You don't have tax due in the UAE on the overall income. Like you have elected for the small business leave, you cannot enjoy. In the UAE, if your income, natural person have income less than 1 million, you cannot enjoy the foreign tax credit. If your income is qualifying free zone person, you are generating qualifying income, you cannot take the foreign tax credit. If you are overall tax loss, you cannot enjoy the foreign tax credit. Even you have the foreign tax paid out of the UAE, but overall basis you are making loss, you are not paying tax, any tax is not due, then you will not be liable to calculate the foreign tax credit. This is quite obvious because whenever we are applying this technique And if I'm asking this portion is zero, once this portion is zero, it will become zero here as well. Once it will become zero here, here it becomes zero here as well. Once this is zero, it will become zero here as well. Once it will become zero, then the requirement of the law is due in the UE source income paid. Lower of due, lower of paid. Due is zero, paid is zero point 0.5. It means you will not be able to claim any tax in the UE, no foreign tax credit. Difference, the timing differences can be there as well, and there is a possibility that you have paid tax out of the foreign jurisdiction today, and you will be claiming this back in the UE tomorrow. There is a possibility because basis can be different. The law says whenever that foreign source income will be taxable in the UAE, then you will take the foreign tax credit. Otherwise, you will not be able to take the foreign tax credit. Assuming out of the UAE following cash basis in the UAE, following in the UAE, out of the UAE, you are following the accrual basis. UAE, in the UAE you are following the cash basis. So foreign source income will be taxable in the UAE on cash basis. So any foreign tax credit that you already paid earlier, it will be considered at that time. Apple to apple comparison. When the income will be taxable, you will be able to take the foreign tax credit. When the related income will not be taxable, you will not be able to take the foreign tax credit. Is allowed even the foreign, this clause we have already discussed. Even the double tax treaty doesn't exist, still you can claim the foreign tax credit. You need to maintain the documents like source income, exchange rate, all these documents you need to maintain. Official receipt that you have paid the tax out of the UAE, you need to prove the withholding tax certificate, copy of the returns, confirmation letter from the relevant tax authority. It shows that you have paid the foreign tax credit. So this is over from my side. We can quickly go through the guide. We have 10 minutes only, but we will be going through the guides very quickly. We'll be focusing on the examples only, okay? A few of them, not even all of them. Okay. You can go through this. These are the same thing that we've already discussed. I'm just quickly going through the examples. This is the same diagram, by the way. We have produced this diagram in the very, very beginning when this law was introduced. Natural person who lives in the citizen of UAE is engaged in the following business: brokerage, interior design, turnover from business account 800,000, set up a sole proprietor business in the UAE, rendering brokerage services for commercial properties to various clients in the UAE as well as out of the UAE. Business carried out by A entirely in the UAE, and the services are rendered to various clients in country U. The employees' assets. These are the services in the UAE. These are the services out of the UAE. Okay, in the case turnover of brokerage services contracted in the UAE 800, which is below 1 million, hence he is not subject to tax. A is carrying out the business. This is a business in the UAE. This is a business out of the UAE. If the natural person is conducting businesses out of the UAE, it will not be subject to tax in the UAE. Only business revenue related to the business in the UAE is subject to tax. This is a natural person income is less than 1 million, so it will be not be subject to tax. It has been written in the conclusion. Natural person lives in a country B is engaged in the following business: manufacturing and sale of papers. Factory in country B, sale of paper, license from a licensing authority in UAE. This is country B out of the UAE. This is in the UAE. We need to check what is the total income from the UAE. Then income from the craft paper business would be subject to corporate tax in the UAE. Income from the business of manufacturing selling paper would not be. Manufacturing and selling paper out of the UAE, it will not be subject to tax in the UAE. This is in the UAE, it will be subject to tax in the UAE. Mr. B is a natural person again. If the income is more than 1 million, it will be subject to tax. Otherwise, it will not be subject to tax. These are the very basic provisions. You can go through this, guys. Okay, I can discuss with you this example. Foreign source income attributable to the UAPE. Company A is incorporated in and tax resident of country X. Company A is incorporated in and tax resident of country X. Okay. It managed outside the UAE but has a PE. Therefore, company A is a non-resident person. Okay. This company A has a PE in the UAE. UAP has made a loan to company G. The security collateral on the loan is immutable property. Property is outside of the UAE. This income is basically this is the foreign source income. Interest received the P on the loan does not have a UE source income. This is not a UE source income because these are the conditions for the UE source income. Loan is not secured. The borrower is outside. Borrower is not a government entity, non-resident person. Since the foreign source income is attributable to company A's PE in the UAE, the interest will be subject to corporate tax in the hands of company A PE. This is a very simple example. UEP of the non-resident person has given a loan out of the UAE. That loan is not a UAE sourced income. This is the foreign source income. And if there is any tax withheld on this foreign tax source income out of the UAE, then UEP of the non-resident person will be able to take the foreign tax credit. Foreign sources. Company A in the business of distributing consumer goods worldwide. During this is the company, just keep in mind, this is the company, they in distribution consumer goods received the following 1.5 million revenue from the UAE sourced income, revenue from the customer, this is foreign source income, dividend, wholly owned subsidiary. We are assuming this will be under the participation exemption, it will be exempt. 1.5 million dividend from a wholly owned subsidiary in corporate resident country X. This is a dividend from company B in the UAE, straightforward exempt because we are assuming this is being received from the juridical person. Under the participation exemption, assuming this will be out of scope as well. Both are exempt. This income is subject to tax. Foreign source income is 900,000. What they said, such receipts, it cannot adopt the cash basis because this is again, this is important thing. Whenever you are assessing, you need to apply a cash basis or accrual basis. You need to consider this total income, even exempt, even taxable. So this is the example specifically for this. They said the total income, if you are considering this is more than 3 million. So you cannot apply cash basis of accounting. Exempt income, you need to include it while calculating this threshold. Loss related to the foreign source income. Uh, Okay, let's go through this. Company G Incorporated engaged in the export of electronic item has in foreign source income and incurred expenses during the relevant tax period as follows. Export of goods, dividend received from participation. It will not be subject to tax. It will be subject to tax because this is the foreign source income. This is the cost of goods sold, marketing and distribution expense, in managed investment in a foreign participation expense, accounting net and profit. Now determine taxable income of country G. Company G. Dividend will not be, it will not be considered for taxable purposes as the income less expenses 5 million. This loss can be carried forward starting in subsequent years. So it will not be subject to tax. 20 less 10, 10 less 15, negative 5. This income and this expense will not be considered because apple to apple comparison, if we are not paying tax on the income, we should not claim the expense as well. So remaining is 10 less 20 less 10, 10 less 15, 25. This is the, so based upon this income expenses results in a 5 million loss and can be carried forward. You can go through this. So foreign participation exemption, expenses, dividend, the same thing they have highlighted. If you're not considering income, you should not consider expense as well. Remaining, you need to calculate how much is your loss. Whatever is your loss, you can carry forward based upon the general principle. This is aggregation of local income and foreign source income. Aggregated domestic and foreign cost calculated, and this is generic thing that I'm not going through this. Related party transactions. Yeah, I think we have not discussed this. If there is a PE or any company out of the UAE, any transaction between the UAE resident company and out of the UAE, it will be considered an arm length basis and transfer pricing rules and regulations will be applicable. This example is regarding that. This is we are discuss more than 10,000, less than, where you need to pass the VD, where you can adjust in the return. We have already discussed this. Company A is incorporated in and tax resident in country X. It is managed outside the UAE, but the P of the, therefore the company is a non-resident P. Company of the has granted a loan to company E resident in country Y. The interest on the loan is foreign source income. Permanently, the resident income subject to withholding tax. P, the corporate tax payable by company X withholding. This is same thing. P of the non-resident person has given a loan out of the UAE. Tax has been withheld. Whatever the tax it has been withheld, they have right to claim the foreign tax credit. These all are the provisions of the foreign tax credit. Here we'll spend some time on the one or two example. Rest of the example you can go through this. Company A incorporated in a resident in the US, total net taxable income 10 million. Relevant tax period 1 million from country X. So UAE sourced income is 10 million. Foreign source income is 1 million. The country A has paid the withholding tax of 50,000. Now the income will be consolidated based upon the generic principle. It will be 10 million. Sorry, 10 million is including this 1 million. So total income is 10 million, tax paid on the foreign source income. How much is the tax due on this? 10 million less 375,000 to 9%, 866,250. Now, weighted average basis, how much is the tax due on this income? 866,250 into 1 divided by 9, or into 1 divided by 10, sorry. So this is 86625. How much tax they have paid? 50,000. Lower of this is 50,000. 50,000 you can claim the foreign tax credit remaining. So 50,000 they have paid it here. Tax due is 86625. Out of this, lower of this is 50,000. They have right to claim credit for 50,000. Excess foreign tax credit. They said if the foreign tax credit, any amount excess that you have paid that you are not able to claim in this tax period, you cannot carry it forward, you cannot carry it back, it will lost. So you can go through this example. The same, this is 10 million, expenditure 2 million, taxable income 8 million. Then corporate tax due is same principle, less 375,000 into 9%, 38250. Foreign tax credit, whatever you have paid, how much you have paid, tax due and tax paid equivalent to 100,000 tax withheld. 100,000 they have paid out of the UAE, and tax due is how much? Tax due is 38250. They have 100% foreign source income. They don't have any UAE sourced income. So 38250 or 100,000, lower of this is 38250, and corporate tax payable is 0. This, they said, this is unutilized tax credit. You cannot carry it forward, carry it back. It is lost straightforward. This is the same thing they are repeating again and again. You can go through this. If the company has tax loss, overall basis, you cannot claim the foreign tax credit. This example is on that. Accrual or realization basis that we're discussing. There can be a timing difference. Once there is a timing difference, you need to consider this. I have already told you, when the foreign source income, when this foreign source income is being considered for tax purposes in the UAE, then you can claim the foreign tax credit. Otherwise, you cannot claim the foreign tax credit. That is important. Just look into the company A company incorporated, a resident in the UAE has a PE in a foreign country, country X. In the year one, the assets of the PE are revalued at fair value in accordance with the applicable accounting standards, resulting in unrealized gain. In year two, the company has sold the asset and PE, thereby realizing the gain. So unrealized gain in the foreign jurisdiction, and the next year they are selling and realizing the gain. In the year one, unrealized gain, and the year two, realized gain. In the UAE, company A has not elected for foreign PE exemption. It is elected to take into account gains and losses on realization basis. This is important. So out of the UAE, you had unrealized gain in the first year. In the second year, you have sold the assets and you have realized the gain. In the UAE, you are following the realization basis. Means in the first year, you will not consider the income of the foreign related income. You will not consider, because you are following the realization basis, and that Gain is unrealized in the UAE, out of the UAE. You are following the realization basis. So when you will consider this income, when the foreign source income will be realized, when the income will be considered for tax purposes, whatever the tax that you have paid out of the UAE, you will consider that tax as well. Otherwise, you will not be able to consider that tax. So first year is unrealization basis. Second year gain realized. You are following the realization basis within the UAE. In the year one, unrealized gain is not part of the taxable income. Why? Because you are following the realization basis. And so credit for foreign tax credit cannot be claimed in the year one. In the year two, you will include the income in your taxable income, then you will take the foreign tax credit as well. They have given the same example. Company incorporated and resident in the UAE has a PE in the foreign country, country X. In the year one, the assets of the PE are revalued, market and according with in the year three, the assets PE they will be realizing. Okay, year one unrealized, year two unrealized, year three you have realized the gain. In the UAE, profit are including unrealized gain 2 million. Profit or tax in the country X on accrual basis. Here the tax on accrual basis country is now taxable income equivalent to 300,000. Profit of the PE, unrealized gain 100,000. This is total. This is tax paid out of the UAE. In the UAE, you are following the realization base. In the UAE, company has income of foreign PE, has not elected for PE. It has elected to take into account gain and loss on a realization basis. So in the UAE, you will be liable to pay tax in the year three. You will be getting the credit in year three as well. In the year one and year two, even there is a gain, but this is the unrealized gain, and you are not following the unrealization basis, you are following the realization basis. So apple to apple comparison, whenever you are in the year 3, in the year 3 you will make the adjustment, and year 1 and year 2 you will reverse the unrealized income because you would have prepared your financial statement on accrual basis. Once you have prepared your financial statement on accrual basis, the unrealized gain in the foreign country will be part of your financial statement. You need to eliminate that. So for the first year, you will be eliminating, you will not be considering taking the foreign tax credit. Second year, you will be eliminating, you will not be taking the foreign tax credit. In the third year, you will be including the income in your taxable income and you will be taking the foreign tax credit as well. As I told you, whenever the foreign source income will be considered for tax purposes in the UAE, you will be able to take the foreign tax credit, otherwise you can't. You can see in the first year, this is a total accounting income. It has been reduced. It has been adjusted because we are following a realization basis. The foreign, this is unrealized gain. This is a taxable income. Okay. Now in the same way, this is year one. You can see corporate tax base, whatever you are 300 PM paid out of the UAE, this is zero because you are not paid anything of it. In the year three, you will adjust it. Year three taxable income is how much? 500,000. Corporate tax due this. Then tax paid on this, you will be able to claim this. Anyway, you can go through this. Important thing I've already told you, apple to apple comparison. If your income is being taxed in the UAE, you will be able to take the foreign tax credit. Otherwise, you will not be able to take the foreign tax credit. If any income is included in your consolidated financials as per the IFRS, you need to adjust it to arrive at the taxable profits. Different period, this is the same example, you can go through this as well. Okay guys, thank you very much. Thank you, and I really appreciate it. If you have any question, you are most welcome. UAE Free Zone Company has a subsidiary in India. UAE Free Zone Company has a subsidiary in India and has given loan to Indian company. Okay. The Indian company is deducting withholding tax on interest paid. Okay. UAE company doesn't have any other income. It doesn't have enough profit to claim the withholding tax. How can UAE company recover withholding tax? If on overall basis, if you have loss, I've already told you, you cannot take the foreign tax credit. But important thing is, for India case specifically, you need to get the tax residency certificate from the Federal Tax Authority, And if you don't have any PE in Egypt, in India, you need to prove that you are a resident of tax resident for the UAE. You don't have a PE in India because you are merely given a loan in India. Then Indian authorities will not be withholding any tax, because we have already done so many cases like this in the past. Wherever we don't have they don't have the PE, then means they don't have any branch subsidiary over there. They are just given a loan over there, and then based upon this, Indian tax authority should not withhold it. But we need to go through the Indian law as well. Might be they are asking, they need to hold, you need to claim it back. In Egypt, as I mentioned earlier, if you are giving a loan, your customer will be withholding it, and after withholding it, they will be giving to Egyptian tax authority. You can claim from the Egyptian tax authority by proving you are a resident of the UAE, you don't have PE in Egypt. The same thing will be applicable here as well. So you need to go to the Indian law. If this is written there, they need to withhold it and pay to the Indian tax authority. Then you can claim it back 100%, I'm sure, by proving that you don't have any PE there and you are a tax resident of UAE. What is the treatment of withholding tax deducted in Oman related to the year before introduction of the corporate tax? That you cannot claim. If the tax has been deducted before the introduction of the corporate tax law, you cannot claim it. But this is a subsidiary. It is, if this is your subsidiary, then you cannot claim it. This is your subsidiary. Withholding tax proven is maximum 9%, and will not be allowed 9% in the UAE, because in the UAE you don't have any taxable profits. We have just discussed, if you have losses in the UAE, I'm coming back to the same question. Nand is asking the same question, that they are giving a loan to the India. They have a subsidiary in India, means that subsidiary will be liable to register for corporate tax purposes in India. They will be liable to submit the return. They need to pay tax. Whatever the tax being paid in India, UAE company has right to claim the foreign tax credit, but they need to have taxable profit. UAE company doesn't have any taxable profit in the UAE, so they will not be able to take the foreign tax credit. Any other question? No? Okay, guys, take care. Thank you very much and have a lovely evening. Thank you. Bye bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.